welcome. Good evening. You're watching The Money Show. I'm Kavita Thapalial with you, and this show is the one that puts your money matters front and center in a world full of financial noise. We are here to bring you clarity, confidence, and control over your personal finances, whether you're planning for retirement, building a portfolio, navigating debt, or just trying to make smarter money decisions. This is your space, your guide, your weekly check-in with your wallet. Every evening, we bring you insights from top financial experts, decode the latest trends, and answer your burning questions on saving, investing, spending, and everything in between. Because here on The Money Show, we believe one thing: you don't have to be a finance expert to take charge of your money. You just need the right advice. All you have to do is just send across your queries, because this is a show where we just don't discuss about investment strategies and instruments. We also answer your portfolio-related queries. Just in case anything you want to ask us or get your investment strategies assessed by our experts, WhatsApp us your queries. You can also email us your questions. Everything is being flashed on the screen. All right, so let's move on and let's begin with our first topic of the day. Post-pandemic, India's investor profile has entered a whole new phase. It's not just about metros anymore. Tier 2 and Tier 3 investors are now eager to explore equity as an asset class. Month after month, the data is clear. More Indians are stepping into the market. But here's the contrast. Equity penetration in our country is still lower than even OTT subscriptions. Now, that speaks volume about our investor mindset, ready to spend on monthly entertainment but hesitant to commit to wealth creation. This is where the transition becomes critical. For decades, India has been a nation of savers, comfortable with fixed deposits, recurring deposits, or gold. But today, there's a new journey unfolding, from traditional saving products towards mutual funds and market-linked options. The challenge, however, is how do we convince the lifelong FD investor? We can't say stop investing there, but we can and must show them why diversification matters, why equity is essential for long-term growth, and why mutual funds are perhaps the most accessible way to make the shift. So today we explore this change in investor behavior, what it means for wealth creation in India, and how mutual funds can bridge the gap between safety and growth. So let's understand this transition from traditional saving mindset to embracing mutual funds. I have with me Ankur Thakore, Chief Business Officer, HSBC Mutual Fund. Ankur, hi, good evening and welcome to the show. So clearly, as I was just talking about, Ankur, we have entered a new phase of investor profile since the pandemic. How do you look at this change scenario, which is also reflecting in our monthly data? Why it's high time India embraces equity, more than the OTT subscription? I would like to add really that. We are not really comparing the entertainment aspect, but then, yeah, come on. We are talking about investing in mutual funds, which is investing through SIP. It's possible. And SIP is what, 250 rupees now, the Chotu SIP. So how would you like to assess this trend?
Yeah, thank you, Kavita, for having me on the show. Let me start off with the good news part of it, that
Sure.
We've seen a far deeper penetration than what it has been in the past with regards to the Tier 2, Tier 3 cities participating into mutual fund industry. As you rightly said, that it is still far smaller as compared to an OTT subscription. I'll talk about that. But before getting into it, I think one of the biggest positives which have happened as technology for us is the democratization of information, which means that the access of information is the same in Tier 2, Tier 3 cities, which is helping now people to kind of come forward and participate because they now have the information. Also, COVID led to one big change is the acceptance of technology, use of technology, especially from a financial perspective. A lot of people were earlier hesitant in terms of trying to invest through a platform or do it digitally. Today, people are far more comfortable, and that is what is also helping us to kind of penetrate into the Tier 2, Tier 3 cities. I think the other part which I have to really talk about is the growth of digital platforms, which makes our operational accessible very, very easy for people to actually go and do transactions. And finally, I would say, obviously, it's the beginning, but the Mutual Fund Sahi Hai campaign has surely helped to create that brand image. Now, talking about how does an OTT subscription versus an investment change happen as a mindset, that we still have a long way to go in terms of number of customers whom we would like to kind of target in. I think it's human psychology. Typically, instant gratification, which is what you can get through OTT subscription, is far more important than the delayed gratification. The investment is a delayed gratification because you really don't realize the benefit of it till the time its kind of final objective has been met. I think that's a learning process and a teaching process. A lot of effort is being put in terms of that investor education, where we can kind of reach out to more and more people. It's a slow process, but I would say we are moving in the right direction, because the growth which we have seen in tier 2, tier 3, and even in tier 4 cities is encouraging. And you said that 250 rupees SIP surely could be a good starting point for people to start accessing the mutual fund business and look at the long-term investment benefit out of it.
All right, so very interesting. I also want to understand the kind of trend that we are looking at, from tier 2 and tier 3. In fact, if I have to talk about B30, we are seeing a new investor class joining equity. But then, Ankur, I really want to focus on one particular aspect. It's good that they are participating in equity. The numbers are really going up. We're looking at millennials, we're looking at Gen Zs being more invested, in tuned with investing, okay, as compared to the earlier generations. But having said that, they want to adopt anything or invest in anything which is short term and which makes them a quick buck. Would you agree with that?
So it's a mixed bag,
Sure.
Kavita, in terms of there are some who are looking at more as a trading as an opportunity, making quick buck and getting out of it. At the same time, there is a set of people who know why they are really investing into and truly differentiate between savings and investment and trading. So there is some positives there. I wouldn't say everything is perfect. In the journey, while we are going through this piece, there will be some pitfalls. People would want to make quick bucks. And we've seen that in the market, that many a times people tend to get significant benefit because of sheer luck. And that luck, they tend to believe that that's how the reality is. But to continue and do it on a sustained basis is very difficult for people to do that successfully over a long period of time. So it's a mix of both. There are a set of people who have kind of learned the hard way. uh, Trying to play the longer term game has been one of the key areas, especially in the younger generation. In fact, when we meet younger generation, what I understand today from people who are 18, 20, 25 years, and if I have to look back when I was 18, 20 years old, I think today's generation knows more, surely because of the fact that the information is available, but also that they made an effort to move into that direction of investing. And I think that's a positive sign.
Of course, we see today's generation taking care of the financial planning of the earlier generation. So I think that really says a lot. But then let's put focus and spotlight on diversification. It's hard to convince an investor who has been, let's say, fixed deposit investor all their life. So we cannot tell them that, you just stop investing in fixed deposit or any traditional form of investment that they trust a lot. But how do we make them understand the importance of equity now that they should be having a bit of exposure, and maybe just to taste it, they can go in a hybrid category, the first step towards understanding the asset class?
Sure. I think it's a very valid point in terms of people tend to choose FDs before they start investing in anything else, because FD by nature has an assured return, which is what people feel comfortable. But let me take a pause and step back here. Is that first and foremost, our step should be to able to tell people to differentiate between savings and investments. And when I say savings and investments, savings is what we need from a near-term perspective, and we put aside that money where you will see no depreciation on your capital and get some returns on it. Versus investing is the longer term goal objective which we have set for ourselves. And that differentiation or that distinction is what our effort should be towards kind of convincing people. A lot of effort needs to be made on it, because when we talk about equities or hybrid products, the first big challenge is that there is no assured returns. You have to kind of tell them that we don't know what you're going to make money next year, next week, but yeah, surely over a longer period of time, you can track something which has seen in the past. Now, when that is the situation, then education of making those investment long term and inflation beating is the first piece which we tend to really talk about. And I think when people were to transition from FD to equity, I think it's not one end to the other, which means that you go from the safest product to the most aggressive product. In between, as you rightly mentioned, there are a lot of hybrid products starting with as low as 15% in equity and going all the way till 100% equity would be the journey which we need to build up. Moment you get people from move from one end to the other, it's a very difficult explanation to do if things were to not work out in the early part of their journey. So gradually moving them up from hybrids on to full-time 100% equity is a journey which we would need to get people to kind of imbibe and build on.
All right, Ankur, I think it's time up for me on this particular segment, but thank you so much for taking time out and helping our viewers understand the benefits of planning their financial portfolio, which is slightly more tilted towards equity, and definitely the importance of diversification. Thank you so much for being on the show today.
Thank you, Kavita. Thank you for having me.
All right, time for a quick break, but then you don't have to go anywhere, because we'll be talking to our viewers and we'll be getting their portfolio strategies checked by our expert. But before that, let's also flash our WhatsApp number and email ID on the screen so that you get to know where to send across your questions, anything about investment, insurance, credit card, or even your repayment of loans or your tax queries. Send it across on our WhatsApp number and email ID. We'll be joined by Vivek Karwa, who will be answering your portfolio queries after this break. Moving on, and let's talk about your PF, and this is a good news for all the PF account holders. Tracking your provident fund balance has always been a bit of a hassle. Multiple logins, waiting for the full passbook to load, and at times delays in reflecting transactions. But now the EPFO has rolled out a new solution called Passbook Lite. It's a quick snapshot of your PF account. With this service, members can instantly check their PF balance, monthly contributions, and recent withdrawals in a simplified format without going through the detailed passbook portal. Now, for those who still need in-depth information, the full passbook remains available, but for everyday use, the light version promises faster and smoother access. Another big change is on the PF transfer fund. Whenever you change jobs, moving your provident fund balance from your old employer to the new one often creates confusion. Now, this process uses what is called Annexure K, a transfer certificate generated by the previous employer. Until now, this document was not easily accessible to employees. But going forward, members can directly download Annexure K in PDF format from the portal and even track the real-time status of their PF transfer. This means greater transparency. Now, to speed up settlements further, EPFO has also delegated powers of approval. Exactly. Earlier, many claims, advances, corrections had to wait for senior officers' clearance. Now, a larger share of these responsibilities has been handed down to assistant commissioners and junior officers, ensuring faster processing and fewer delays for members. Now, all these measures are a part of EPFO's ongoing 3.0 reforms. The focus is on improving efficiency, cutting red tape, and making provident fund management as transparent and user-friendly as possible. For nearly 30 crores EPFO members, this could mean quicker access to their savings, smoother transfers when they change jobs, and faster approvals for claims and advances.